Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button.
Oh,
Now let's break down what's happening in the markets today in a clear and simple way. What if I told you that being the smartest person in the room is actually like the fastest way to lose all your money in the stock market?
I mean, it sounds completely backwards, right?
It really does, because when you first start looking at the American economy, especially if you are just a beginner trying to manage your own money, there is this overwhelming assumption that building wealth is all about raw brain power.
Yeah, people think it's a test of intelligence.
Exactly. You think, if I just read enough financial reports or, if I memorize enough economic data, I will somehow crack the code. But based on recent analysis into the psychology of investing, the exact opposite is often true.
It is incredibly counterintuitive. We are looking at some, well, really fascinating behavioral economics research today, specifically drawing from Gary Belsky and Thomas Gilovich's work on why smart people make big money mistakes.
Right.
And we're combining that with some very fresh market data from May 2026. The central thesis we are exploring in this deep dive is that high intelligence can actually be a massive liability in the financial markets.
So our mission today is to figure out exactly why incredibly smart people constantly fail to capture major market returns. Like, what behavioral traps are they falling into?
And more importantly, how to fix it.
Yeah, exactly. For you listening, we want to show you how you can set up simple, actionable systems to avoid those same pitfalls. Because, the sheer volume of financial information hitting you right now is just dizzying.
It really is.
We have this massive AI boom, sticky inflation, shifting political landscapes. But today, we are going to make navigating the psychology of all of that perfectly clear.
To understand this, we really have to look at how smart people handle being wrong. A highly intelligent investor usually knows a lot of facts,
Right, they do their homework.
Exactly. They understand central bank policies, complex valuation metrics, geopolitical risks. But what's fascinating here is that when an investment starts losing money, they don't use that massive intellect to correct their course.
Wait, really? What do they do instead?
Instead, they use their brain power to construct these incredibly elaborate, bulletproof defenses for their bad decisions. They essentially become like high-priced defense attorneys for their own mistakes.
Okay, let's unpack this. Because this is a psychological mechanism every single one of us uses in everyday life, not just in investing.
Oh, absolutely.
It is like arguing with a GPS that tells you are going the wrong way. But because you happen to be, let's say, a geography major, you confidently drive your car straight into a swamp.
That is a perfect analogy.
Right. You are totally convinced, a secret shortcut. Use your deep knowledge of topography to justify why the swamp is actually a faster route, rather than just admitting, hey, I missed the highway exit.
And what happens while your car is sinking in that swamp? You start blaming the mud, the weather, the car suspension, basically anything but your decision to ignore the map.
Right, it's never your fault.
Never. In the market, the danger is almost never the simple act of being wrong. Every single investor is wrong at some point. The actual danger is the inability to change your behavior when the facts change.
So what does that look like in practice?
Well, let's look at a specific example from the data regarding artificial intelligence stocks. Say an investor buys an AI company's stock purely because they expect massive earnings growth next quarter.
Okay, that makes sense as a starting point.
Right, that is their initial thesis. But then the earnings report comes out and the profits are just terrible, the stock price drops. Instead of reevaluating and selling, the smart investor shifts the narrative.
Here comes the defense attorney.
Exactly. Suddenly they tell themselves the reason for holding isn't immediate earnings anymore. Now it's about, long-term market share.
The story just magically morphs to fit the new reality.
Precisely. Or let's say interest rates rise. When rates go up, tech stocks often drop. The smart investor doesn't sell. They pull out a financial textbook and say, well, this is just a temporary discount rate shock. The underlying business is fine.
They just keep moving the goalposts.
Yeah, they continuously string together new, highly intelligent-sounding sentences to justify holding the asset. They never stop to check if their very first assumption was broken. Good investing isn't about having the most articulate explanation for why your account is bleeding money.
It's about adapting.
Exactly. It's about adapting.
Which brings us to the psychological engine that actually drives all of this desperate rationalization. If rationalization is the weapon we use to defend our bad choices, what is powering that weapon?
That would be the sunk cost fallacy.
Right. The research points to this one core culprit.
Based on Belsky and Trilovich's research, the sunk cost fallacy is this really dangerous psychological habit of dragging past costs into your future decisions.
And when we say costs, we aren't just talking about the physical dollars you paid for the stock.
Right. Not at all. It is the dozens of hours you spent researching the company on the weekends. It's the emotional pain and anxiety of holding the stock while it drops 20%.
Yeah.
It is even the social cost of having bragged about this specific company to your friends at a neighborhood barbecue.
Oh man, that social cost is heavy. Nobody wants to be the person who confidently told their friends to buy a stock only to walk back to them a month later and admit it was a terrible call. It's just embarrassing.
It is deeply uncomfortable, and because of these accumulated sunk costs, investors do not become more objective about a failing asset as time goes on. They actually become more obsessed with it.
Wow, that's wild.
Admitting a stock is a bad investment stops being a simple math problem. It starts to feel like a personal indictment. It feels like admitting, I'm a failure. You turn a basic market decision into a massive battle to protect your ego.
Here's where it gets really interesting.
Right.
The research provides this ultimate clarifying question to just cut through all of that psychological baggage.
It's a great tool.
Yeah. If you're staring at a losing stock in your portfolio and your stomach is in knots, you just need to ask yourself one single thing. Would I buy this specific stock today at today's price?
Right. It strips away all the history and forces you to look at the present reality.
Because if the answer is no, if you wouldn't touch that stock today with fresh money, then holding onto it makes absolutely zero sense. The original price you paid is vanished information. It's a ghost.
The market does not know what you paid for it.
Exactly. And the market certainly does not care if you are currently down 30%.
There is a concept often attributed to the writer Kurt Vonnegut that perfectly encapsulates this mindset. He essentially noted that taking a step back after going down the wrong path is actually a step in the right direction.
Oh, I love that.
When applied to your portfolio, admitting you are wrong and reversing course is not a defeat. It is the vital, active skill of risk management. The market is an entirely forward-looking mechanism, but the investor trapped in the sunk cost fallacy is entirely backward-looking.
They're basically staring in the rearview mirror while driving on the highway
Exactly.
and looking at the reality of the market right now. Based on recent analysis from May 2026, this psychological trap isn't just a minor mistake that trims your profits anymore. It can be totally fatal to your portfolio.
Without a doubt.
We are navigating a fast-paced American economy with incredible cross-currents, and stubbornness is being punished severely.
According to recent data, the market is shifting at lightning speed. We are seeing global stocks rising on the back of corporate earnings, but underneath that calm surface, the currents are violent.
What kind of currents?
Well, we have serious Middle East tensions affecting energy markets. We have ongoing inflation burdens that just won't go away, massive shifts in how companies are spending money on artificial intelligence, and, major policy changes happening under President Trump. The environment is highly dynamic.
And on top of those macro events, you have retail investors, just regular American beginners trying to grow their wealth, trading these volatile swings using these hyper-fast, internet-driven frameworks.
Right, the meme culture.
Yeah. The analysis points out that retail traders are moving massive amounts of money based on concepts like FOMO, the fear of missing out, or FAFO, which stands for fool around and find out.
Which is incredibly risky.
Basically taking reckless risks just to see what happens. And TACO, there are consequences, okay?
Yeah.
Which is this bizarre acknowledgement of the extreme volatility they're playing with. Because of this high-speed environment, the old school era of just blindly holding on to a losing position and hoping it recovers is largely over.
The structural mechanics of the market have fundamentally changed. We now have extremely high leverage in the system, meaning people are trading with borrowed money. We also have a massive volume of what are called 0 days to expiration options, or 0 DTEs.
Can you explain that for the beginners listening?
Sure. An option is just a contract to buy or sell a stock. Usually you buy months of time for the stock to move.
Yeah.
0 DTE means the contract expires today, like in a matter of hours. It literally turns the stock market into a high-speed casino. And you combine that with crypto derivatives, which is essentially placing side bets on digital currencies using even more borrowed money.
So if you are stubborn in this environment, it's not just that your stock slowly goes down over 5 years. With that much leverage and speed, a stubborn judgment leads to a forced liquidation. Your broker issues a margin call, sells your assets without asking you, and you get entirely wiped out in an afternoon.
Exactly.
Plus, the analysis shows that even traditional safe assets are behaving weirdly right now. Usually when stocks fall, you rely on bonds to go up and protect you. But with sticky inflation and oil supply issues, stocks and bonds are frequently dropping at the exact same time.
The old safety nets have huge holes in them. If we connect this to the bigger picture, the margin for error is simply much smaller today. The psychological biases that cost people 10% in the 1990s can cost them their entire net worth today.
But wait, I have to push back here. Isn't patience supposed to be the golden rule of investing? I mean, from day one, beginners are told that buy and hold is the ultimate secret to building wealth. Doesn't reacting to these fast changes in selling stocks contradict the most fundamental advice we have?
That is a very common point of confusion. Buy and hold is a fantastic strategy, but it is only valid if your original long-term assumptions remain intact. Buy and hold does not mean buy and ignore.
Okay, what's the difference?
Let's say you bought a company because it had a total monopoly on a specific technology. Then a massive tech giant enters their space, releases a better product for half the price, and completely crushes their profit margins. The fundamental facts of why you bought that business have permanently changed.
Right.
Refusing to sell and calling it long-term investing isn't patience in that scenario. It is avoidance. You are just hiding from reality.
That makes a lot of sense. So since this 2026 market environment aggressively punishes that kind of stubborn avoidance, how can you spot when you are actually lying to yourself? The research outlines the most common excuses we use to justify holding on to bad positions.
Yeah, the data highlights 5 major rationalizations. The first is exactly what we just touched on, telling yourself, oh, it's a long-term investment. This is the single most common excuse used to mask terrible short-term performance.
So they didn't actually plan for it to be long-term.
Nope. An investor buys a stock hoping for a quick 10% bounce. The stock drops 20% instead. Rather than taking the loss on a bad trade, they suddenly declare themselves a long-term investor. They change the rules of a game while the ball is in the air.
And the second excuse is a classic. I'll sell when it gets back to break even. I see people do this all the time. You buy a stock at $50, it drops to $30, and you swear you will sell it the second it touches 50 again.
It's so common.
It's exactly like sitting through a completely terrible 2-hour movie at the theater. You realize 10 minutes in that the movie is awful. But because you paid $15 for the ticket, you refuse to leave. You sit there suffering for 2 hours, secretly hoping the second half will magically refund your wasted time and money.
Which it won't.
No, you are never getting that time back.
And the market doesn't know your buy price. The stock doesn't know you need it to hit $50. Waiting for break even is incredibly destructive because of opportunity cost. While your money is trapped in a bad company waiting for a miracle bounce, you are missing out on putting that capital into a thriving company that is growing right now.
Yeah, that makes sense. What if the third lie we tell ourselves?
The third excuse is, it dropped 50%, it can't drop much more. This is a complete misunderstanding of math. If a $100 stock drops 50%, it is now at $50. If terrible news comes out again, it can drop another 50%, taking it to 25.
It can always be cut in half again.
All the way down to zero. A severely cheap stock price doesn't automatically mean you are getting a bargain. It very often signals severe underlying risk that the rest of the market has already figured out.
The fourth excuse is relying on the crowd, saying everyone else is holding it, so I should too.
This one is especially dangerous right now in heavily crowded, hype-driven trades like AI infrastructure or meme stocks. When you look around the internet and see thousands of people holding the same asset, it feels safe. You feel validated.
Right, safety in numbers.
But crowd behavior is only safe until the underlying consensus breaks. When the narrative shifts, everyone heads for the exact same exit door at the exact same time. The liquidity dries up instantly, and the financial damage is catastrophic.
And finally, the fifth lie, which is just the ultimate ego trip. My analysis is right, the market is just wrong.
You might have built a brilliant spreadsheet. Your fundamental analysis of a company's balance sheet might be mathematically flawless. But your portfolio is valued by the actual market price, not by your pride.
The market doesn't care how smart you are.
Exactly. If your timing is off by 3 years, or if the market simply doesn't care about the metrics you are looking at, your correct analysis will still result in massive financial loss. The market can remain irrational much longer than you can remain solvent.
Wow.
This raises an important question, though. If human beings are biologically wired to make all these excuses, How do we start focusing on the money we've already lost and start focusing on the opportunities we are currently missing out on?
That is the big pivot. What is the actual solution? Because wealthy, highly successful investors do not possess a crystal ball.
Ah,
They don't have a magical ability to predict the future better than anyone else.
no, they don't.
What they do have is the ability to fail small. They have strict, unemotional systems in place to override their own human psychology.
Mm.
The research gives us a clear playbook with 5 actionable rules to fix these behaviors.
The first rule they follow is incredibly simple, but almost no one does it. Rule 1, write down your initial reason for buying the asset in a single, clear sentence. Before you buy, write down, I am buying this stock because I expect their new software division to increase revenue by 20% this year.
Literally write it down.
Literally write it on a physical sticky note and put it on your monitor.
That forces honesty. You literally can't shift the goalposts 6 months later and claim you bought it for long-term brand value if the sticky note right in front of you says you bought it for software revenue.
Precisely. It anchors you to your original thesis. The second rule builds on that. Set your withdrawal conditions before you ever hit the buy button. You need to decide the exact metric that will cause you to exit the trade.
Like setting a tripwire.
Exactly. Are you going to sell if the stock drops a hard 15%? Are you going to sell if the CEO leaves? Are you going to sell if a specific government policy changes? You make that decision when your head is completely clear and objective, before your money is on the line and your emotions take over.
You are essentially pre-programming your own escape pod while you are still safely on the ground, rather than trying to build a parachute while you are in a free fall.
That's exactly right. Rule 3 addresses how to handle a falling stock. Only average down, which means buying more shares of a stock as its price drops to lower your average cost if your core thesis from that sticky note is entirely intact.
Okay, so don't just buy because it's cheaper.
Right. You must have undeniable proof that the price drop is due to temporary, broader market panic. Buying more shares of a fundamentally broken company just because the price is lower is the purest, most destructive form of the sunk cost fallacy.
Right, if you find yourself buying more just to make yourself feel better about the red numbers on your screen, you're just throwing good money after bad.
Rule 4 changes how you review your accounts. Evaluate your portfolio based on your underlying assumptions, not just your financial returns. Most people just open their app, look at what is green and what is red.
Guilty as charged.
We all do it, but instead, look at the business facts. Ask yourself, are the reasons I bought these companies still true today? If a stock is up 40%, but the core reason you bought it is no longer valid, you sell it. If a stock is down 10%, but your core thesis is perfectly intact and the business is growing, you can confidently hold it.
You completely flip the script. You stop staring at the fluctuating stock price and you start staring at the underlying facts of the business.
And finally, Rule 5. Keep cash on hand. Cash is obviously a financial buffer, but more importantly, it is a psychological asset.
Wait, hold on. I have to challenge this one.
Yeah.
We are talking about the reality of May 2026. Inflation is still a major ongoing burden. If I am sitting on a pile of cash, I am literally losing purchasing power every single day. The money is quietly decaying in my account. Isn't holding cash a terrible idea right now?
Mathematically, yes, cash loses value to inflation.
Yeah.
But you have to weigh that slow decay against behavioral destruction.
What do you mean by behavioral destruction?
If your portfolio is 100% invested in stocks and you have zero cash, selling a losing position feels terrible because you feel entirely stuck. But if you hold a reasonable cash position, it gives you immense psychological comfort. It gives you the mental flexibility to admit defeat, sell bad stock, and know you have the dry powder ready to wait patiently for a much better, safer opportunity. Giving up 3% to inflation is vastly superior to losing 50% because you were too psychologically stressed to make a rational decision.
So what does this all mean? When you look at all these rules together, writing down your thesis, setting escape metrics, keeping cash, a major underlying theme emerges for the beginner investor. And that is the absolute necessity of diversification.
It's crucial.
Spreading your money around isn't just a financial shield to protect your net worth from a single bankruptcy. It is an incredibly powerful emotional shield. If you put all your money and all your intellectual identity into one single artificial intelligence stock, admitting you were wrong about it feels like total destruction. It absolutely crushes your ego.
Yeah, it hurts.
But if you spread your bets across different sectors, different asset classes, admitting you were wrong about one specific tech company is just a minor course correction. It's a blip. It doesn't destroy your identity.
That is a critical realization. And it highlights the ultimate lesson from this deep dive into investment psychology. We spend so much time worrying about the money we lose on a bad trade. But the most expensive cost in investing is rarely the monetary loss from a single bad stock.
It's the opportunity cost.
Exactly. The most devastating cost is the incredible, life-changing, wealth-building investments you are completely missing out on because your capital and your mental energy is trapped in a stubborn, losing position that you are too proud to let go of.
Investing isn't a college debate club where you win points for having the smartest, most articulate argument for why your portfolio is down. The market doesn't award grades for effort. It's a game of capital allocation.
Yeah.
Intelligent people fail when they let their giant intellects defend their past mistakes instead of actively hunting for new opportunities.
Well said.
The absolute greatest skill you can develop in this fast-moving, wild market of 2026 isn't the ability to predict the future. Nobody can do that. It is the ability to hit the update button on your own beliefs. When you finally realize you have climbed up the wrong tree, climbing back down isn't a defeat. It's literally the only way you are going to find the right tree.
I want to leave you with a final thought to mull over today. Think about a deeply held belief you have right now. This doesn't even have to be about a specific stock in your investment portfolio. It could be a belief in your career trajectory, your relationships, or your broader worldview.
Okay, I'm thinking of one.
Ask yourself this. What specific, undeniable piece of evidence would it take for me to completely change my mind? If you cannot picture exactly what would prove you wrong, are you actually making an informed, rational decision? Or are you just fiercely defending your own ego?
If you can't even imagine the evidence that would prove you wrong, you're basically driving into that swamp on purpose, just to prove the GPS wrong. And nobody wants to be stuck in the mud. Don't forget to subscribe and hit that like button.